I'm going to share with you my portfolio today. 13 stocks that I currently own. We're going to go through them, some of the 8 pillars and the stock analyzer in each one. Let's pull it up. Stock number 1 is Target. And guys, by the way, I actually own 19 positions, but 2 of them are ETFs, GDX and GDXJ, just for gold miners. And 4 of them are too small for me to be able to discuss in this channel. They're small positions, so that's why we're not talking about them. These 13 are positions you're allowed to own. But remember, don't buy anything just because somebody on the internet does. Learn a process, apply that to the things that make sense to you. So Target, $168 a share. Guys, it was as low as 103 or so. 101.88 back in December of 2023. Let's look at the 8 pillars here. Okay, so these are 7 check marks. Now remember, guys, this is not to tell you to buy or not buy. This is purely telling a story and answering that story. Now, one of the things I would say here is long-term liabilities divided by 5-year free cash flow. Guys, Target has a lot of leases. They count as debt. That's 6 times. To me, this is just a check mark. So I look at this as an 8 check mark company. And at $101 a share, that was pretty awesome. I started buying it sub 135 all the way down. I think my lowest purchase was around 103 or 105. So I didn't clip the bottom, but that's why when you understand why you buy a company, as it goes lower, you continue to buy more. So what is Target worth to me right now? Let's pull it up because I haven't done this in a while. January 18th of 2024. I made some assumptions here, some reasonable assumptions on revenue growth, some reasonable assumptions on profit margin and free cash flow, 2.5 to 5.5 on revenue growth, 3.25 to 4.75 on profit, same on free cash flow. Now, PE and price of free cash flow. Target is loved by women. Women love going there and they love spending money there. So I sat there and put 15, 17.5, and 20. It's still retail. It's still physical location on retail. So it's always apprehensive for me. And I put my desired return at 9%. Again, only market return. Hit the analyze button. I have a low price of 111, high price of 240, middle price of 167. Have my watch list at 135. I think it's reasonable to account for some margin of safety. Because remember, there's no margin of safety in these numbers. Stock number 2, Sprouts Farmers Market. $2.7 trillion market cap. This company's at $62 a share. Guys, I've been buying it in the low to mid 30s and I've been mad that it keeps going up. It is absolutely just skyrocketing. They have a great new CEO, came from Dollar Tree or Dollar General, one of the two. Here's the 8 pillars. Guys, a great company can look expensive as it's growing. And again, retail, so it has higher lease costs. Now, obviously at $30 a share, $35 a share, the PE and price of free cash flow were a lot lower. So what's the reasonable amount on this company? And by all means, guys, if you want to take a look at this company and my assumptions in more detail, please do look. But I currently have a low price of 32 to 35, a high price of 60 to 70, middle price of 45 to 50. I have my watch list of 40. I think that's reasonable. One could make the argument of a higher price because it's growing. They only have 400 locations or so. They want to get to 1,500 or 1,250. So there's a lot more potential for growth there. Stock number 3, Brookfield Asset Management. Guys, this one is going to be one that I wish it was as simple as, hey, here's the cash flow, et cetera. They have a lot of investments. They've done a lot of things. They've also lost some properties to foreclosure, given keys back to the bank. But I like their potential. This one, very quick. It has more to do with its long-term revenues and how set in place they are. The stock analyzer tool looks great on it, but there's a lot of moving parts in this company, and I had somebody help me out with this one, and we made the investment decision together. Stock number 4, Southwest Airlines, LUV. Southwest, $22 billion company. This is a company. Look at this. Look at their profit margin, 1.78, 1.24 for the last 5 years. If you go before COVID, they were 10 to 15% all day. So my bank here is the fact that they have record revenue, $26 billion, which is higher than pre-COVID. They've had a lot of issues, especially with the 737s and some of their computer issues as internally as a company. I'm buying this purely as what happens when they get back to normal profit margin. So all the more reason why I want to pull up Southwest Airline in our stock analyzer tool and show it to you. I didn't even do 15% as my middle. So I'm looking at these assumptions here, very reasonable assumptions in the company. 9% desired return, it's green all around. Again, no margin of safety, But I look at these numbers going, okay, I like this. Now, what catalyst am I waiting for? I'm waiting for stabilization of profit. That's it. Once we get to stabilization of profit, even if it gets to 7 or 8%, I should still do well in this company. Stock number 5, Disney. Another play just like Southwest, where margins are very low, 3.4, 3.9%, when historically they were, again, 10% or more. So again, this plays exactly the same as Southwest. In fact, look at this exciting 8 pillars. Not pretty. 6 X's. But to me, with record revenue, as long as they get back to a normalized profit margin, which might take some time, but even if they get their profit margin to 7, 8, 9%, probably does pretty well for the company. And unfortunately for me, Disney stock has been up a lot lately. And so here are my assumptions here. I did do 12% in the middle. I did 6, 12, and 18 because they have the Disney Plus, a lot of high margin stuff. Hopefully they're able to figure out a way to make really good money on it. I hit the analyze button. I have a low price of 46, high price of 128. Sorry, middle price of 128, high price of 270. So even at the middle price, if I bought it today, I'm still going to make an 11% return based on a discounted cash flow. Stock number 6, American Express, $2.19 a share, 52-week low of 140, guys. 140 per share. That's pretty impressive. Look at the 8 pillars here. Not bad. A lot of debt. I'm okay with that based on what American Express is. But look at this price to free cash flow, 12.2 versus a PE of 23.6. They're showing $17 billion in free cash flow last year. And they're showing $13 billion average of the last 5 years versus net income of $8.4 billion last year and $6.8 billion in the last 5 years. So for those of you who are new, we love when free cash flow is greater than net income. Love that. And they pay a little bit of a dividend, nothing major, 1.1%. Eats up only $2 billion of their free cash flow. That's pretty awesome. So let's go to Stock Analyzer. See where we stand on this one because I haven't done this in a while. I haven't updated it. January 16th, I did it. 4, 7, and 10% revenue growth. Profit margin, 12, 14, and 16. Free cash flow, much higher. Remember, because look at their free cash flow relative to profit margin. I actually did 18, 21, and 24. This is the elite credit card company. So I want to give them the elite premium for it. If I asked everybody out there today, name me the most elite credit card company, the exclusive one, people would say American Express all day. Hit the analyze button, assuming no margin of safety. Look at all this green. It actually worries me that I'm missing something because of how high these potential returns are. So if you're out there and you understand something about American Express that I don't get about the numbers, drop it in the comments below. I'd love to hear it. Stock number 7, Generac. Oh my gosh, guys. I got my first purchase of Generac and then the stock skyrocketed from there, which really, really irked me. Absolute God's honest truth. I hate it when stocks I buy go up, especially when I just started the position. I made one purchase of Generac. It started to go lower and then it skyrocketed 50%. I'm in the acquisition mode. I want to purchase more shares. I don't want to sit there and buy a small amount and watch it skyrocket. I want it to go down and down and down. So Generac, great company for generators. You drive around, you see generators out there. This is what you see. Let's go look at the 8 pillars here. 5 checks. Net income is down, but free cash flow is up over the last 5 years. So I like to see that. At least the free cash flow is up versus net income. A little bit higher debt. Okay. Can't be perfect. I'm fine with that. Now, one thing I don't like here is the 5-year PE is lower than the price to free cash flow, which means they're reporting higher net income in the last 5 years than free cash flow. That really bothers me. And if you see right here, 340 million 5-year average net income versus 270 5-year average free cash flow. Okay, not the greatest. So let's pull it up in our stock analyzer tool and see what Generac might be worth. We did it on February 20th. I did 4, 6, and 8% revenue growth. Guys, look at this. They had 12% decline in revenue in the last year. That's a lot. That's a big drop. Is it because of people spending less money on their homes? I don't know. Here's our price. Low price of 100, high price of 210, middle price of 150. I have it on my watch list at 100. Doesn't mean I'm buying it at 100. It's on my watch list. So obviously you're watching this video for one pure, simple reason. You want to make more money. And investing with confidence and finding your own path and the things that make sense to you will only lead to better results as long as you follow a process that makes sense to you. You're absolutely the product of the people you surround yourself with. There's this old saying that the 5 people around you, the average of them is how you're going to turn out. And there's a great book by Shane Parrish where he says, join a group where their expected result is what you choose to be, what you want to be, because then you're going to elevate yourself to that level. And I'm offering you that opportunity in Everything Money in this community of thousands of like-minded investors. Now that I've surrounded myself by these guys, I go in there, I engage, I ask questions, they respond, people ask questions of me, I respond. There's no way that I'm the best investor in this group. There are some phenomenal investors out there. I've already found a few that I sit there and say, if I didn't know how to manage my own money, I'd give them my money. It allows me to make better decisions. If I ask a question or somebody asks a question of me that I don't get, it gives me the indication, Paul, go learn more about this. So no matter where you are and where you want to go, somebody in here can help you with that. And that's the main key here. And guys, I'm offering it today. Special $7 for 7 days. Click the link below or go to everythingmoney.com, $7 for 7 days. Check it out because you want to elevate your game by being around people who are elevated themselves. Stock number 8 is Rowe Price. Now, guys, Rowe Price, I actually just heard a commercial for them yesterday when I was watching the Cavs game, which I thought was funny. Rowe Price, money manager, lots of assets under management. This one has a lot of potential for some downfall if the markets fall. Obviously, the stock will fall because their assets under management are falling. But I do think it's a good company. For all you people out there who love dividends, look at this dividend, 4.27%. I'm okay with the dividend because I don't know what kind of reinvestment opportunity they have. But when I start to see this PE start to fall, it gets me a little concerned here going, why the heck are they paying out this dividend? Now, some things I don't like about the company, lower 5-year free cash flow and lower 1-year free cash flow versus net income. So that's something to get your head around. But they have a good return on invested capital over the last 5 years. They have that great dividend for people who love dividends, including myself, by the way. Let's go to the 8 pillars here. 2 X's, free cash flow and net income are down over the last 5 years. Is it annoying? Sure. But look at these valuation metrics. I love this valuation. And if it gets driven down even further, it could be a better buy. Let's do our stock analyzer on this one. When was the last time I did this? February 13th. I actually did a 20-year analysis, guys, because I look at Rowe as a 20-year plan. It's not just 10 years, it's 20 years. I really want to look at this even longer than that. So I did 3, 5, and 7% revenue growth, which I think is conservative considering if markets go up more than 5% a year for the next 20 years, that'll drive up the revenue even without new business. 26, 30, and 34% profit margin, lower free cash flow margin. I put 15, 17, and 19 on the PE and price of free cash flow. And again, the 9% desired return. Hit the analyze button, low price of 100 to 120, high price of 250 to 285, middle price of 160 to 185. This is a company that's been going back and forth for a while. I'm going to continue to own it and keep buying it where it makes sense to me. I have my watch list under 92.5. That might be too low, and I think I know why I did that, because it kept going lower. I kept changing it, so I need to change this now, probably to 115, because I was buying it below 115 before, but as it was going lower, I was setting new watch list prices and never updated it after it skyrocketed back up. Stock number 9, Paycom. Oh, guys, Paycom. Paycom fell suddenly one day down to 150 a share from like $200 and some a share. I got very lucky. I bought it that day, and then it skyrocketed from there. If you actually look, the 1-year chart, that was the day I bought it. I think I got it at 149 or so. It hit low of 146, and then it's just gone up since then. Now, it's starting to come back down, which is great. It's at 181 a share, all-time high of $558 a share, guys. $558. So this is why you don't look at just the price fall. You look at it as an indication of, hey, and remember I had Paycom on my watch list for 150 and it got there real quick. I loved it, made a purchase. I'm not done buying Paycom, but for right now, let's see what we think. Let's look at the 8 pillars here. Valuation metric. Look at this valuation metrics, the 5-year PE versus the 5-year price of free cash flow. Let's check out the analyst estimates here. This is where I like Paycom a lot. Look at this jump. It's payroll software. As payroll gets larger and larger and larger, as people make more and more money, it's going to naturally drive their revenue in addition to extra business. And look at the revenue growth, double-digit revenue growth. This is the kind of company you need to pay a premium for. So What was my premium? Let's see what I was paying for Paycom back in October of 2023. So I did 6, 10, and 14% revenue growth. I did profit margin of 18, 20, and 22. Now, if you look at their free cash flow margin, it is lower. It's been pretty consistent at 17%. Because of their higher gross margin, I did put a little bit higher free cash flow margin in there. PE of 17, 20, 23. Now, desired annual return so far back. Let's do our 9% in here. Boom. A low price of 115 to 130, high price of 510 to 560, middle price of 236 to 263. I think I put it lower at 150 only because I was worried about recession coming imminently and maybe I could be more patient and buy it at a better price. Realistically, I probably should change it to a 170 strike price so I can at least then start selling puts at lower prices. So I'm changing that on the software here. It's already updated. All right. British Tobacco is an interesting company. So tobacco is not exactly a very popular business right now. However, British Tobacco is down to $30 a share, all-time high in 2017 of $46. For those of you who love dividends, can I tell you guys something right now? 5% dividend yield. Look at this price to free cash flow. If anybody out here works at British Tobacco, can you please get them to cancel this dividend and buy back their shares? Guys, $6.5 billion in dividends versus a $65 billion market cap, they could be buying back 10% of the company every year. If the stock stayed the same price, they would drive up their earnings per share by 10x just by buying their shares back every single year. But it'll drive up the price. I think it's one of those situations where it's just a negative company based on the industry they're in. But worldwide, there's still a good margin and still a growing world, Africa, India, that's going to continue to smoke cigarettes and do other products. And hopefully they take their cash flow and can diversify a little bit. 8 pillars, 5-year PE versus the 5-year price of free cash flow. I think there was a write-off in here, and that's why it's such a different. Because look at their 5-year net income, 17.13, very close to their 5-year free cash flow of 18. So, all right, guys, let's see. Let's look at analyst estimates. Even analysts have their EPS going up, 484 a share to 752. Revenue declining, though, in the future. Not a lot of revenue growth. But again, with good margin, good multiple, they buy back their shares, they're going to do great. Hopefully somebody can get out there and get them to buy back those shares. I do the stock analyzer tool. I just think this is a perception problem on the company. September 23rd, look at my assumptions of revenue. Now, this one I actually did do higher margin, desired return. -3% revenue growth. So I'm having declining revenue growth, -1 and 1, 20, 24, and 28 for profit margin. Free cash flow, 30, 33, 36. Look at my PE. Actually, let me go. Yeah, hit the analyze button. Look at this thing, guys. 43 to 65, 70 to 90, 55 to 75. This is not for the faint of heart. The perception of this company has to change for value to be released. I'm making that bet. Will it happen or not? I don't know. I bought it around 30, so I'm a little bit down right now. I'm fine with that. If it fell to 15 and everything was still the same, I'd probably buy more. If it fell to 20, I'd buy more. If it fell to 25, I'd buy more. In fact, let me add to my watch list at 27.5 and probably sell some puts on it. All right. Next company, 3M. They've had some legal issues lately. Their balance sheet isn't amazing, not awful, but not great. Free cash flow is great. Look at this. They took their write-offs and their lawsuits very early. They showed a $7 billion loss here, but look at that free cash flow. $5 billion and $5.4 billion. Dividend, 6.4%. 10 times price to free cash flow. 3M, would you do me a favor? Would you save your $3.5 billion you pay out in dividends every year and buy back your shares? Please. Or pay down your debt. Either one. Or a combination of both. Guys, this is an example. And I was talking to somebody the other day in our community where they said, gosh, I wish 3M would just stop paying this dividend. I was like, I agree with you 100%. They're like, yeah, the stock would probably fall. I'm like, I don't care. The stock needs to fall. They need to stop their dividend and start buying back shares and paying down their debt. That's it. Be a long-term investor. Don't be short-term oriented. Let's look at the 8 pillars here. 4 X's, 4 checks. Is what it is. Not great. Look at this net income. Down $11.5 billion because of that write-off. So let's pull up stock analyzer tool. With margin of safety in here. 12.5% margin of safety. It's still green. Low price of 75 to 85, high price of 120 to 130, middle price of 95 to 105, with margin of safety of 12.5%. Not bad. 12.5% annualized return versus 9. All right, next company, PayPal. We just did a video on this the other day. PayPal is a company, look at this. All-time high was $310.16 on July 26, 2021. 52-week low, $50. That's down over 75, over 80% down. I don't think PayPal is going away. Their revenue keeps going up. There is an issue with PayPal. The number of users has started to decline, but their overall number of transactions, as well as the value of the transactions, continues to climb. Do I like the fact that users are declining? Absolutely not. Is that an issue? Absolutely. But at these valuation metrics, I can't ignore the company. And I look at this thinking to myself, okay, look at analysts. They're calling for double-digit EPS growth. This is not a popular stock. The stock has been beaten down from 310 to 50. There's two wide ranges here. PayPal's dead, PayPal's a value. One of them is going to be probably right. Which one's it going to be? I will say, if I had 30 companies like PayPal to buy, I would buy them. I'd love to own 30 companies that look like this. Revenue growth. Again, high single digits, low double digits revenue growth. According to analysts, again, take it with a grain of salt, but let's pull up PayPal in our stock analyzer tool and see what it looks like. This assumes no margin of safety, 9% return, 3, 5, and 7% revenue growth, which I think is conservative over the next 10 years. Decent profit margin, higher free cash flow in the last 5 and 10 years than net income, which is great. Guys, here are my prices. 50 to 60 on the low side, 120 to 160 on the high side, 80 to 100 in the middle. I think the juice is worth the squeeze here. That's my opinion. But again, if you're not feeling it, if you don't understand that, stay away from PayPal. Final company, last but not least, my biggest holding, Alibaba. I am down on my Alibaba, and I am quite okay with that. I think the negativity surrounding China is insane. Are there issues with China? Absolutely. But China is a growing economy, fast-growing economy, fastest-growing middle class in the world. Yes, it has a declining population, but this is the number one company in China. All-time high of $320 a share back in October of 2020. Now it's at $75 per share. Guys, I don't know what to tell you besides, look at this. Free cash flow of $26.5 billion versus $14 billion of net income. 5-year average free cash flow of $20 billion versus $15 billion. They're buying back shares. They announced a dividend. Alibaba, why'd you do a dividend? Come on, guys. This is 7 times price of free cash flow. Just buy back your shares, please. Stop with this dividend nonsense. I feel like I got to teach everybody that dividends are not the greatest thing in the world, especially when you have such a cheap company like this. So let's just look at the analyst estimates here. Look at this, $9.20 a share, not big growth on EPS, but funny thing is, I look at this and I'm not understanding. How is the revenue growth made to high single digits and the EPS growth not as much? I don't get that, but let's see. Let's look at stock analyzer tool, Alibaba. We did it on February 7th. No margin of safety here, 3, 6, and 9% revenue growth, 15, 19, and 23 profit margin, free cash flow of 17, 22, and 27. PE 16, 18, and 20, yada, yada, yada. Hit the analyze button. It's green all around. Low price of 120 to 140, high price of 340 to 400, middle price of 200 to 240. Guys, if you want to see the other stocks I want to own, the other 30 stocks I want to own, watch this next video.